Right. I want you to picture a scenario. It's a Tuesday night, early February 2026.
Okay.
You had a long day at work. You got a bit of savings sitting there. Maybe
Yeah.
you've pulled some equity out of your own place. And you decide to do what every Australian does to feel, productive. You open the real estate apps,
The doom
the
scroll.
property doom scroll, exactly. You filter for Sydney, maybe the inner west or the eastern suburbs. You look at the prices, you look at the rental estimates, and you do the mental math.
Yeah.
And the math, well, it's depressing
It's brutal. You're looking at yields of 2, maybe 3% if you're lucky.
if you're lucky.
And that's a gross yield before you even start talking about maintenance, let alone the bank taking its share.
Right. It feels like you're parking a huge amount of capital for a return that barely beats a savings account. So you widen the net. Brisbane, Perth. But today, we're doing something different. We're looking 12,000 kilometers away.
Mm-hmm.
We've got a stack of research here, anchored by a guide dated just a few days ago, February 2, 2026, called Unlock Dubai Property ROI for Australians.
And we should be clear right off the bat, this isn't a travel brochure. We're not talking about holiday homes. This is a deep financial analysis of a market that's been grabbing headlines for all the right and sometimes wrong reasons.
The mission for this deep dive is really to stress test the hype. We keep hearing tax-free income and double-digit yields, which, that usually triggers the too good to be true alarm.
It does.
We want to find out if the Dubai market in 2026 is a legitimate wealth-building vehicle for Australians or if it's a mirage full of hidden costs.
And it's a timely question because the Dubai of 2026 is structurally different from, say, the Dubai of 2020 or even 2024. The dynamics have really shifted.
Okay, so let's set the scene. The sources mentioned that 2025 was an absolute rocket ship.
It was a massive year. I mean, we saw capital growth hitting around 15% across the board. That was the gold rush phase.
Right.
But if you look at the projections for 2026 in this guide, the curve is, flattening. We're moving into a stabilization phase. Forecasts are sitting between 5 and 8% growth.
Which is an important distinction. So if you're an adrenaline junkie looking for a quick flip, you might have missed the peak.
You might have, but if you're looking for stability, this might actually be a better thing.
Right.
That's the argument. The market is maturing. It's becoming less of a speculative casino and more of a genuine global hub, like a London or a New York, just with a very distinct economic advantage.
Let's get straight to the numbers then, because that's what we're all here for. We mentioned Sydney is offering a paltry, 2.5 to 3.5% yield?
Yeah, on a good day.
So what's the reality on the ground in Dubai right now?
Well, the spread is quite wide, but the averages are compelling. For
Already double.
But the guide identifies specific high-demand pockets places like Sport City or Jumeirah Village Circle, where yields are still hitting between 8 and 13%.
13%. I mean, just pause on that for a second. In an Australian context, you don't see 13% unless you're buying a dodgy mining town.
Idonga, yeah, or some really risky commercial real estate.
Exactly. But yield is only one side of the coin. The other side, which usually kills the vibe for Australian investors, is what happens at tax time.
The tax man cometh.
Yeah.
Or in this case, he stayeth away. This is the holy grail aspect mentioned in the source material.
Okay, unpack that, because as Australians, we're conditioned to the ATO, negative gearing, capital gains. Zero sounds fake.
I know it does. But for an individual investor in Dubai, there is 0% tax on rental income.
So you collect the rent and it just sits in your account.
It sits in your account. It is pure net income, conceptually speaking.
Yeah.
You don't declare it on a tax return in the UAE.
Mm-hmm.
And maybe even more significantly, there is zero capital gains tax when you sell.
So if the property goes up by 200 grand, you keep the 200 grand. No discounting method, no handing half of it back.
Correct. Now, obviously, you have to talk to your Australian accountant about how that income is treated if you bring it back home.
Of course.
But strictly from the UAE side, the tax bill is zero.
How does the place even run? Are the roads paved with good intentions?
The infrastructure is world-class, but the model's different. The UAE government doesn't fund itself through income tax. It's through corporate revenues, consumption taxes like VAT, and transaction fees. It's a fee-based economy.
Right. Okay, so the tax environment is a win, but there's a massive variable we haven't touched on, and it's one that scares a lot of people. Currency. We aren't buying in Aussie dollars.
No, and this is where the sophistication level needs to ramp up a bit.
Yeah.
You're buying in UAE dirhams, or AED. And the critical thing to know is that the dirham is pegged to the US dollar.
Pegged meaning it's locked.
Yep. The exchange rate is fixed. So when you buy a property in Dubai, you are effectively buying a US dollar asset.
So for an Aussie investor, this is really a currency play as much as a property play.
Absolutely. You are taking a position on the AUD exchange rate. If the Aussie dollar is weak, which, let's be honest, it often is against the greenback, it becomes more expensive for you to buy in.
Your dollars buy fewer dirhams.
Exactly. But once you're in,
Then what?
once you hold the asset, a weak Aussie dollar is actually your friend. If the AUD tanks, your rental income, which is pegged to the USD, buys you more Australian dollars when you convert it.
So it acts as a hedge. You're diversifying out of the Australian ecosystem.
That's a great way to frame it. But remember, it cuts both ways.
Right.
If the Australian economy goes on a tear and the AUD surges back to parity with the US dollar, your repatriated returns from Dubai will shrink.
So you have to watch the Forex charts as closely as the property listings.
Okay.
Let's assume I'm comfortable with that. I want to buy. I'm an Aussie citizen in Melbourne. Can I just buy? Or do we need a local partner?
No local partner needed. The guide is very clear on this. There are designated zones known as freehold areas.
And freehold in Dubai means the same as freehold in, say, Brunswick.
Identical legal concept. You own the unit, you own the land share. It's your name on the title deed. This applies to all the major investment spots. Dubai Marina, downtown, Palm Jumeirah.
I've heard the term leasehold thrown around, though.
That does exist, usually for 99-year terms, but it's generally restricted to older areas or specific zones. As an international investor in 2026, you're almost exclusively being funneled into freehold markets.
Okay, now let's talk about getting over there. The guide mentions the golden visa. It sounds like something from a movie.
A bit more practical than Willy Wonka, yeah. It's a residency incentive. The government wants to retain wealth and talent. If you invest 2 million dirhams, which is roughly 700,000 Australian dollars, you qualify for a 10-year residency visa.
700 grand. In Sydney, that's barely a deposit on a terrace house. In Dubai, that's the property and a 10-year visa.
That's the trade-off. And that visa covers your spouse and children. It allows you to work, start a business, and this is the kicker. There is no minimum stay requirement. You don't have to live in Dubai to keep it active. Just visit once every 6 months.
So it's a plan B. It's lifestyle insurance.
Exactly. But we need to talk about how you fund that 700K. Because you might not have that sitting in a redraw.
Right. Can I walk into a Dubai bank as an Aussie and get a mortgage?
You can, but don't expect the same cozy terms you get at Combank or Westpac. The market is open to non-residents, but the banks are more conservative.
How conservative are we talking?
You're looking at a loan-to-value ratio, an LTV, of 50 to 75%.
So that means a much bigger deposit.
A substantial deposit.
Yeah.
Typically, you need to put down 40 to 50% of the property value in cash.
Right, so leverage is lower. You can't do a 5% deposit scheme here.
No, and money is slightly more expensive. Interest rates for non-residents are variable, usually hovering between 4 and 6%, depending on what the U.S. Fed is doing. So while the property price is lower, the cash you need to get in is actually quite high.
Speaking of cash, let's talk about the hidden costs. Every market has them. In Australia, stamp duty makes you cry. What's the damage in Dubai?
You need to budget an additional 7 to 8% on top of the purchase price.
That's a chunky amount. What's in that number?
The big one is the DLD fee Dubai Land Department. That's a flat 4% of the property value.
So that's their version of stamp duty.
Exactly. Then you have the agency commission, standard at 2%, plus trustee fees, conveyancing.
So on that 700K investment, you're finding another 50K or so just to get the keys.
Correct. You start your investment journey in the red, just like here. It's not a fee-free entry, even if it is tax-free ongoing.
Okay, I've paid my fees, I've got my visa, I've swallowed the deposit. Now I'm looking at listings. The guide splits the market into two main camps, apartments and villas. Classic yield versus growth battle.
It is, and the gap between them in 2026 is fascinating. If you want cash flow money hitting your bank account every month, you buy an apartment.
And that's where those 8% yields are hiding.
Yes. Apartments have a lower entry price, maybe 30 to 40% cheaper than villas, and they have a massive tenant pool. Singles, young couples, the transient expat workforce, it's a volume game.
And the villas.
The villas are the capital growth play. The yields are lower, think 4 to 5%, but the appreciation has been staggering. Between 2020 and early 2026, prime villa prices jumped over 90%.
90% in 6 years. That's crypto territory.
It was a huge structural shift. post-pandemic. Everyone wanted space, gardens, privacy, but the guide warns that the entry price for villas is now very, very high. You're buying at the top of a steep curve.
So if I'm late to the party, maybe apartments are the safer bet for 2026.
For income stability, yes. Specifically in areas like Jumeirah Village Circle or JVC or Business Bay. These are the workhorse suburbs.
Right.
They aren't the ultra-luxury postcards you see on Instagram, but they have high occupancy rates.
But if I want the Instagram postcard, the Palm.
Then you're buying a trophy asset. Emaar Beachfront, the Palm, Dubai Hills. You buy there for stability and prestige, not necessarily for the highest percentage yield.
Okay, here's a debate I see on every property forum. Off-plan versus ready. Buying a drawing versus buying a building. Historically, off-plan was the way to go in Dubai, right? Get in cheap.
Historically, yes. You got a lower price, you got these very attractive payment plans, like paying 1% a month during construction. It was very easy on cash flow.
But the 2026 analysis suggests a change in tactic.
A big one. The expert consensus in the guide is now leaning heavily towards ready properties.
Why the switch?
It all comes down to risk management. When you buy off-plan, you are taking on construction risk. Will it be delayed? Will the specs change? Will the market dip before it's finished?
What you see is what you get.
Exactly. With a ready property, you inspect it, you buy it, and you can rent it immediately. Plus, in a stabilizing market, the discount you get for buying off-plan has shrunk. The gap isn't big enough to justify the risk anymore.
That makes sense. Immediate cash flow trumps a potential future discount that might just evaporate. Okay, this is the part of the deep dive where we have to be the buzzkill. We've painted a rosy picture. High yield, no tax, golden visas. What goes wrong?
2 words. Service charges.
This is the strata fee equivalent.
It is, but on steroids. In Dubai, service charges are calculated per square foot, and they can be incredibly high. We are talking about eating up 10 to 25% of your gross rental income.
Wait, up to a quarter of the rent just gone.
Before you see a cent of profit. This is why looking at gross yield is so dangerous. A brochure might promise 8%, but if the service charges are high, you're netting 5 or 6.
And I assume apartments with all the bells and whistles, pools, gyms, concierges have the highest fees.
That's the trap. Villas are generally cheaper to maintain because you do the maintenance. And a tower, you're paying for the chillers, the elevators, the 24-hour security. You have to check that service charge index before you sign anything.
What about the market itself? We said it's stabilizing, but Dubai has a reputation for being, well, volatile.
It's a high beta market. It amplifies global trends. If the global economy sneezes, Dubai tends to catch a cold faster than Melbourne. It's very sensitive to oil prices, geopolitics, global liquidity. It rises fast, but it can correct fast too.
And then there's the supply issue. I feel like every photo of Dubai has a crane in it.
That's the visual reality, and the data backs it up. 150,000 units launched in 2025 alone. By 2028, we're expecting another 366,000 homes to hit the market.
That is a terrifying amount of supply. Basic economics says if supply outstrips demand, rents crash.
And that is the single biggest risk factor for the next 3 years. The counter-argument is that the population is growing by 200,000 people a year. As long as Dubai keeps attracting expats, the demand is there.
But if that migration slows down and those towers keep going up,
you're left holding an empty apartment with high service charges?
a recipe for disaster.
It really is. You need high occupancy. And finally, regulation. It's not the Wild West anymore, but it's not exactly the tenancy tribunal either. ARERA, the Real Estate Regulatory Authority, is strong and generally pro-investor, but rules change fast. Visa rules, rental caps, short-term letting laws. They can pivot overnight.
So you can't just sit and forget.
No, you need to be plugged in or you need a very good property manager.
Okay, let's pull this deep dive together. We've looked at the February 2026 guide. We see the shift to ready properties. We see the yield potential. What's the final verdict?
I think the Holy Trinity argument holds up. High yields, zero tax, and portfolio diversification. If you're frustrated with Australian returns and you want a USD-pegged asset, it is a compelling case.
Right.
But it requires active navigation. You are not buying a passive income stream, you're buying a business. You have to manage currency risk, you have to calculate net yields after those heavy service charges, and you have to pick your location very carefully to avoid becoming supply glut.
And you have to be comfortable with that volatility. This isn't a sleepy terrace in Paddington.
Not at all. It's high reward, but the risk profile is completely different.
So we'll leave you with this thought to chew on. We mentioned 150,000 new homes are launching, while growth moderates to 5%. The question you need to ask yourself is this: Have we already seen the peak of the post-pandemic Dubai gold rush?
Hmm.
Or are we simply witnessing the transition into a mature global city, a desert Manhattan, where steady, tax-free returns are the new normal?
If it's the latter, 2026 is the perfect time to buy for the long haul. If it's the former, well, watch that supply number very closely.
Thanks for diving in with us.
See you next time.